Before the presidential election this year, one focus of year-end tax planning was on a possible presidential victory for Joe Biden, combined with a Democratic majority in the Senate, that might result in higher taxes in 2021 for high-income individuals, corporations, investors, and estates. Joe Biden has now been projected as the winner of the presidential election, and it appears possible, even maybe likely, that the Republicans could maintain a majority in the U.S. Senate. It looks like the issue won't be decided until the two runoff elections right here in the beautiful state of Georgia on January the 5th. The fact that we won't know the majority in the Senate until next year makes year-end tax planning based on the election results still something of a guessing game. Stay with me, and we'll go over a few ideas for planning for either scenario. Hi, I'm David Weiner, Mr. Cashflow. My work and my channel is dedicated to helping people improve their cash flow, reduce their taxes, and minimize risk. Take a moment to subscribe to the channel, and if this is helpful to you, please smash that like button and share this video with those who might be able to benefit from it. Let me know your thoughts and your potential questions in the comments section below. Let's look at the topic of tax planning for this year based on the recent elections. What if the Senate remains Republican? The possibility of a continued split government means that President-elect Biden may have difficulty getting his tax plans enacted into law. The stock market has been heading higher ever since the election, with investors betting on the divided government. One caution on that optimism is that even the Republican Senate may feel the need at some point to address the growing federal deficit that's come about as a result of the tax cuts in the Tax Cuts and Jobs Act and the pandemic relief provided in the CARES Act. In addition, it's possible that additional pandemic relief might be enacted either in the lame duck session this year or early into 2021. With less concern about significant tax increases early in 2021, year-end tax planning focus can return to some of the more traditional strategies. Assuming that individual tax rates are not expected to increase in 2021, individual taxpayers can focus on the usual strategies of postponing income and accelerating deductions. Strategies to postpone income start with checking current projected income for 2020 and 2021, checking how that income might fall into the individual tax brackets, and then determining if the taxpayer might be pushed into a higher bracket. While many wage earners and salaried employees may not have much control over the timing of their income, self-employed individuals may be able to postpone income by postponing billing, and employees expecting year-end bonuses may be able to negotiate to have those bonuses paid in 2021 rather than being paid in 2020. Corporations may also be able to postpone income into 2021 with less fear of a corporate rate hike in 2021. The parallel strategy to postponing income in 2021 is accelerating deductions into 2020. With higher standard deduction amounts, a bunching strategy for itemized deductions may be even more important, taking the standard deduction every other year and bunching itemized deductions such as charitable contributions or perhaps medical deductions into the off year for the standard deduction. This year may be a good year to bunch itemized deductions with higher limits on charitable donations and a lower 7.5% threshold for medical expenses only available in 2020. Although it may be getting a little bit late in the year to squeeze in some elective surgery. Those who don't itemize can look to the $300 above-the-line charitable contribution, also under the current law, only available in 2020. There are also over 30 regularly expiring provisions currently expiring at the end of this year, with the individual provisions including the tuition and fees deduction, the mortgage insurance premium deduction, the exclusion from mortgage debt forgiveness, the non-business energy property credit, and a couple of vehicle credits. Investors with less concern about a capital gain rate increase in 2021 may be able to focus on the usual year-end strategy of looking over their investment portfolio for holdings they might wish to sell and see how their capital gains and losses for the year match up in deciding whether or not to do the sale in 2020 or to 2021. Capital gains realized might be subject not only to the capital gain tax rates, but also the 3.8% tax on net investment income. With less concern about increased tax rates in 2021, individuals may be less concerned about getting Roth IRA conversions done this year. But retirement planning should continue to focus on changes to the new distribution rules for IRA beneficiaries and the ability to continue to make IRA contributions after age 70 and a half if there's enough earned income to support them. Estate and gift planning also may require less of a year-end focus with less risk of a reduction in the unified credit in 2021 or an increase in estate and gift tax rates in 2021. However, low interest rates may make a year-end gifting program still attractive, although low interest rates are also expected to continue into 2021. So what if the Senate goes Democrat? Should both Democrats win in the runoff election in Georgia, the result could create a 50-50 tie in the Senate. That leaves Vice President-elect Kamala Harris as the tiebreaker in the Senate. That creates a scenario in which President-elect Biden may have a greater chance of enacting his proposed tax increases in 2021. That would include higher individual tax rates for taxpayers earning over $400,000 a year, higher capital gains tax rates on higher income taxpayers, a higher corporate tax rate, and possibly higher estate and gift tax rates and reduced exemption amounts. It may still be possible to plan for such contingencies in 2021 before they take effect, but there's no guarantee of that at this point. While Congress frequently makes tax breaks retroactive, it's been a lot more reluctant to do so with tax increases. Sometimes Congress has made tax increases retroactive at least to the beginning of the year when it feels like the intention to enact the tax increases has been made very evident ahead of time. Taxpayers who are concerned about tax increases in 2021 might consider changing their normal year-end tax strategies. This would include accelerating income and postponing deductions for both individuals and corporations, taking a hard look at realizing capital gains in 2020, considering Roth conversions this year, and looking at making lifetime gifts in 2020 as well. Again, there might be a window to take such actions in 2021 before tax increases would take effect, but again, that's not a certainty either. So, after all the shouting, all the recounting and lawsuits, it appears that Joe Biden has won the presidency. But whether the Democrats control the Senate will not be known for sure until January of 2021. President-elect Biden's tax increase proposals may not be enacted without a Democratic control of the Senate, but history indicates that new presidents often are successful in enacting their tax proposals early in their presidency if their party also controls Congress. Post-election tax planning for possible tax increases in 2021, therefore, requires a little bit of gazing into your crystal ball and planning accordingly. Nothing is quite clear yet about what is most likely going to happen, but I hope this video has given you some food for thought in the meantime. Subscribe to the channel, and don't forget to smash that like button and share this video with anyone you think might benefit. I'm David Weiner, Mr. Cashflow with Cashflow Strategies. After all, it's your money. Keep more of it.